School of Management Studies IGNOU presents an audiobook on the course Mmpc 014 Financial Management for MBA program. Presenting Block 3 Financial Decisions, Unit 10 Capital Structure. The objectives of this unit are to understand the importance of decisions regarding capital structure, discuss the concept of an appropriate capital structure, and identify the factors that have bearing on determining the capital structure. Introduction. Finance is a critical input for any organization, since it is required for both working capital and long-term investment. The total funds used in a firm come from a variety of sources. The owners contribute a portion of the capital, while the rest is borrowed from individuals and institutions. While some funds are maintained in the firm indefinitely, such as share capital and reserves, that is, owned funds, others are held for a long time, such as long-term borrowings or debentures, while yet others are short-term borrowings mostly used for working capital requirements. The total financial structure of the company is made up of the complete composition of all of these funds. You are well aware that the requirement for short-term funds fluctuate a lot. As a result, the proportion of short-term financing is constantly changing. The composition of long-term funds, referred to as capital structure, is frequently governed by a set of rules. The debt-to-equity ratio and dividend determination are two other important parts of policy. The latter has an impact on the accumulation of retained earnings, which is a key component of long-term funds. Because permanent or long-term funds account for a significant amount of total funds and include long-term policy decisions, the term financial structure is frequently used to refer to a company's capital structure. There are some long-term funding options that are commonly available to corporate organizations. Share capital and long-term debt, including debentures, are the key sources. The profit generated by operations can be retained in the business or distributed as a dividend. A reinvestment of the owner's funds is the portion of profits retained in the firm. As a result, it is a long-term fund source. All of these sources combine to form the firm's capital structure. Concept of capital structure. The mix or proportion of different types of finance, that is debt and equity, to total capitalization is referred to as capital structure. It is a measure of a company's entire long-term investment. It includes funds raised by common and preferred stock, bonds, debentures, and term loans from a variety of financial institutions, among other things. Earned revenue and capital surpluses are also considered. Capital structure planning. The construction of a suitable capital structure in the context of each firm's facts and circumstances is referred to as capital structure planning. Because of the possible impact on profitability and solvency, the decision on what type of capital structure a company should have is crucial. Small businesses frequently do not plan their capital structure. Without any explicit planning, the capital structure may develop in these businesses. These businesses may prosper in the short term, but they will encounter significant challenges sooner or later. The company's unplanned capital structure prevents it from making efficient use of its funds. As a result, a company's capital structure should be planned in such a way that it maximizes its benefits and allows it to react more quickly to changing situations. rather than following any specific procedure to determine an appropriate proportion of different types of capital that will reduce the cost of capital while increasing market value, a company can simply copy the capital structure of other similar companies or consult an institutional lender and follow its advice. Theoretically, a firm should build its capital structure so that the market value of its shares is as high as possible. When the marginal cost of each source of funds is the same, the value will be maximized. In general, the debate over the best capital structure is purely theoretical. In actuality, determining an optimal capital structure is a difficult endeavor, and we must go beyond theory. As a result, there are likely to be major differences in capital structure between industries and across enterprises within the same industry. A company's capital structure selection is influenced by a number of things. The judgment of the individual or group of individuals making the capital structure decision is critical. If the decision makers disagree about the importance of various criteria, two similar companies can have distinct capital structures. These variables are psychologically complicated and qualitative, and they do not always match the accepted theory. Since capital markets are not flawless, decisions need to be made with limited information and thus have risk. You may have been interested in identifying some of the key aspects that drive capital structure planning in practice. However, before we go into these details, let's try to understand the characteristics of a good capital structure in the next section. Features of an appropriate capital structure. The capital structure is frequently designed with regular shareholders' interests in mind. Ordinary shareholders are the company's ultimate owners and have the power to choose the directors of the company. The finance manager should try to maximize the long-term market price of equity shares while building a suitable capital structure for the organization. In actuality, there would be a range of appropriate capital structures for most companies within an industry with few changes in the market value of shares. For example, a corporation may operate in an industry with a debt to total capital ratio of 60%. It is possible that shareholders, on an average, do not mind if the company operates within a 15% range of the industry's typical capital structure. As a result, the optimum capital structure for the corporation is a debt to total capital ratio of 45 to 75%. Subject to other considerations such as flexibility, solvency, and so on, the company's management should strive to find a capital structure towards the top of this range to maximize the use of favorable leverage. A sound, appropriate capital structure should have certain features. They are: number 1, profitability. Within the limits, the company's capital structure should be the most advantageous. The most effective use of leverage at the lowest possible cost should be pursued. Number 2, solvency. Excessive debt puts a company's solvency in jeopardy. The debt should only be utilized sparingly. Number 3, flexibility. The capital structure should be adaptable to changing circumstances. If a company's financial structure needs to be modified, it should be possible to do so with minimal expense and delay. The corporation should also be able to supply finances whenever it is needed to finance its profitable activities. To put it another way, we need to approach capital structuring with caution from a solvency standpoint. The company's debt capacity, which is based on its ability to generate future cash flows, must not be surpassed. It should have adequate cash on hand to pay creditors, set charges or interest on a regular basis, as well as the principal payment upon maturity. The characteristics listed so far are typical of an appropriate capital structure. More special aspects may be reflected in a company's characteristics. Further, the importance placed on each of these characteristics may differ from one organization to the next. For example, a company may place a higher value on flexibility than on maintaining control, which is another desirable attribute, while another company may place a higher value on solvency than on any other criteria. Further, if circumstances change, the relative relevance of these factors may shift. Determinants of capital structure. When a firm is promoted, the capital structure must be decided. The initial capital structure should be properly planned. The company's management should establish a target capital structure, and subsequent finance decisions should be made with the goal of achieving that capital structure. The finance department management must deal with the current capital structure once a firm has been created and has been in operation for a few years. The company may require capital to continue to fund its operations. When funds are needed, the management assesses the advantages and disadvantages of various sources of financing and chooses the most favorable sources while keeping the intended capital structure in mind. As a result, the capital structure choice is a constant one that must be made anytime a company needs additional funding. When deciding on a capital structure, certain factors should be considered. Number 1. Leverage or trading on equity. Financial leverage, also known as trading on equity, is the use of fixed cost sources of finance such as debt and preference share capital to fund assets of a company. If the return on debt financed assets exceeds the cost of debt, earnings per share will rise without an increase in the owner's investment. Similarly, if preference share capital is used to acquire assets, earnings per share will rise. However, the impact of leverage is felt more in the case of debt because the cost of debt is typically lower than the cost of preference share capital, and interest paid on debt is a deductible charge from profits for calculating taxable income, whereas dividends on preference shares are not. Financial leverage is an important consideration when developing a company's capital structure because of its impact on earnings per share. Companies have a high level of earnings before interest and taxes, that is EBIT, can profitably use a high degree of leverage to boost their shareholders' equity return. The link between earnings per share or EPS at various possible levels of EBIT under alternative ways of financing is a typical approach of analyzing the impact of leverage. The EBIT EPS analysis is an important tool in the toolbox of financial manager for gaining insight into the capital structure design of the company. She or he can assess potential EBIT changes and their impact on EPS under various financing arrangements. While leverage can boost earnings per share or EPS in favorable circumstances, it can also put shareholders' money at risk because of number 1, the adverse fluctuations in the cash flows, and number 2, higher probability of insolvency as financial risk rises when debt is used. If a company's capital structure is devoid of debt, it can completely avoid financial risk. However, if no debt is used in the capital structure, shareholders will miss out on the benefits of increased EPS due to financial leverage. As a result, a company should use debt only if the financial risk perceived by shareholders does not outweigh the advantage of greater EPS. Number 2. Cost of capital. The costs of numerous sources of finances are a complicated topic that requires its own approach. It goes without saying that lowering the cost of capital is beneficial. As a result, if all other factors remain constant, cheaper suppliers should be favored. The minimal return expected by a source of money is the cost of that source of financing. The expected return is determined by the level of risk that investors are willing to take. Stakeholders take on a higher level of risk than debt holders. The rate of interest is fixed in the case of debt holders, and the corporation is legally obligated to pay interest whether it earns profits or not. The dividend rate is not defined for shareholders, and the board of directors is under no legal responsibility to pay dividends even if the firm has produced profits. Debt holders get their money back after a set amount of time, whereas shareholders only receive their money back when the company is wound up. This leads to the conclusion that debt is a less expensive source of capital than equity. Interest costs are tax deductible, which lowers the cost of debt even further. Although preferred share capital is less expensive than equity capital, it is not as inexpensive as debt money. As a result, a corporation should use debt to lower its overall cost of capital. However, it must be understood that a corporation cannot continue to reduce its overall cost of capital by using debt. Debt becomes more expensive beyond a certain point because of the increasing risk of excessive debt to creditors and shareholders. As the level of leverage rises, the risk to creditors rises as well. Once the debt has reached a certain level, they may demand a higher rate of interest or refuse to lend to the company at all. In addition, the enormous debt puts the stockholders' position in jeopardy. As a result, the equity cost of capital rises. And as a result, while debt lowers the overall cost of capital up to a degree, beyond that point, the cost of capital begins to rise, making it unfavorable to use debt further. Hence, there is a mix of debt and equity that lowers the firm's average cost of capital while increasing the market value of its stock. The cost of retained earnings and the cost of a fresh issue of shares are included in the cost of equity. The cost of debt is less than the cost of both of these equity capital sources. The cost of retained earnings is less than the cost of new issuance. Since the company does not have to pay personal taxes, which are paid by shareholders on distributed earnings, the cost of retained earnings is lower than the cost of new issues. And because, unlike new issues, retained profits do not incur flotation charges. As a result, between these two sources, retained earnings are preferable. When the leverage and cost of capital aspects are considered, it appears appropriate for a company to use a higher amount of debt if its cash flows are stable and do not fluctuate significantly, and the cash flows are over and above the required cash flows to service interest on debt and the principal repayment. In fact, debt can be employed to bring the average cost of capital down to zero. Together, these two parameters determine the maximum amount of debt that can be used. Other considerations, however, should be considered when determining a company's suitable financial structure. Theoretically, a company's debt and equity balance should be such that its overall cost of capital is as low as possible. Number 3. Cash flow. Conservatism is one of the characteristics of a healthy capital structure. Conservatism does not imply the avoidance of debt or the use of a minimal amount of debt. It has to do with determining the obligation for fixed charges as well as the use of reduced debt or preferred capital in the capital structure in light of the company's ability to generate cash to cover these fixed charges. Interest, preference dividends, and principal payments are all part of a company's fixed expenses. If the company uses a lot of debt or preferred capital, the fixed charges will be quite expensive. When a corporation considers taking on more debt, it should consider how it will cover its fixed charges in the future. Interest must be paid and the principal amount of the debt must be returned according to the timelines. A corporation may suffer financial insolvency if it is unable to earn enough cash to pay its fixed obligations. Companies that anticipate big and consistent cash inflows can use a lot of debt in their capital structure. Employing fixed fee sources of finance for organizations whose cash inflows are variable or unpredictable is a bit dangerous. Number 4. Control. When it comes to capital structure design, the management is sometimes guided by its desire to maintain control over the company. The current management team may not only seek to be elected to the board of directors, but also to run the company without influence from outsiders. Ordinary shareholders have the legal right to choose the company's directors. There is a risk of losing control if the corporation issues fresh shares. In the case of a publicly traded corporation, this is not a significant factor to consider. The stock of such a corporation is extensively distributed. The majority of shareholders are uninterested in participating in the company's management. They are unable to attend shareholder meetings due to a lack of time and desire. They are solely concerned with dividends and share price appreciation. By distributing shares widely and in tiny quantities, the risk of losing control can almost be eliminated. In the case of a closely held corporation, however, keeping control may be a key factor. A single shareholder or a group of shareholders might buy all or most of the new shares, thereby taking control of the firm. Fear of losing control and so being hampered by others is a common reason for closely held companies delaying their decision to go public. To avoid the risk of losing control, companies may issue preference shares or raise debt capital. Because debt holders do not have voting rights, it is frequently proposed that a corporation employs debt to avoid losing control. When a corporation employs a considerable amount of debt, the debt holders place a lot of constraints on it to safeguard their interests. These limitations limit the management's ability to run their businesses. An excessive amount of debt may also cause bankruptcy, which means a complete loss of control. Number 5. Flexibility. The ability of a company's financial structure to adjust to changing situations is referred to as flexibility. A company's capital structure is flexible if changing its capitalization or funding sources is not difficult. The corporation should be able to raise funds without undue delay or expense whenever it is needed to fund lucrative investments. When future conditions justify it, the corporation should be able to redeem its preference capital or debt. The company's financial plan should be adaptable enough to adjust the capital structure's composition. It should keep itself in a position to switch from one type of funding to another in order to save money. Number 6. Size of the company. The availability of funding from various sources is heavily influenced by the size of a company. It might be difficult for a small business to obtain long-term financing. If it is able to secure a long-term loan, it will be at a high interest rate and with uncomfortable terms. The financial structures of small businesses are inflexible due to the highly restrictive covenants in their loan agreements. As a result, management is unable to conduct business freely. Therefore, small businesses must rely on their own capital and retain revenues to meet their long-term needs. A large corporation has more leeway in deciding how to arrange its capital structure. It can get low-interest loans and offer ordinary shares, preferred shares and debentures to the general public. A company should make the best use of its size in planning the capital structure. Number 7. Marketability. In this sense, marketability refers to a company's ability to sell or market a security in a given time frame, which is dependent on investors' willingness to buy that security. Although marketability may not have an impact on the original capital structure, it is an important factor to consider when selecting to issue securities. The market may prefer debenture issues at one time while accepting ordinary share issues at another. The corporation must determine whether to raise financing through ordinary shares or debt due to shifting market sentiments. If the stock market is down, the corporation should issue debt instead of ordinary shares and wait until the stock market recovers before issuing regular shares. During a period of high stock market activity, the corporation may be unable to successfully issue debentures. As a result, it should leave its debt capacity unused and issue common stock to raise funds. And number 8, flotation cost. When money is raised, flotation charges are incurred. The cost of floating a debt issuance is typically lower than the cost of floating an equity issuance. This may persuade a corporation to issue debt rather than common stock. There are no floating charges if the owner's capital is enhanced by keeping the earnings. The flotation cost generally is not an important factor that affects the capital structure of a company except in the case of small companies. Now let's summarize the unit. The capital structure of a firm is the mix of long-term financing sources in its total capitalization. Ownership and creditorship securities are the two most common sources. Most large industrial enterprises use both forms of securities as well as long-term loans from financial institutions. A company's capital structure planning is critical to a company as it has a significant impact on its profitability. A bad decision in this regard could be quite costly to the firm. While deciding on a capital structure, it is important to keep the goals in mind such as profitability, solvency, and flexibility. The amount of debt and other fixed income securities on one hand and variable income securities such as equity shares on the other is determined after a comparison of the characteristics of each type of security and careful consideration of internal and external factors affecting the firm's operations. In the real world, concessions must be made somewhere between the aspirations of enterprises seeking funding and the expectations of those who offer them. The fundamental distinctions between debt and equity remain unchanged as a result of these concessions. In most cases, the choice of financing is not between equity and debt, but rather between the best possible mixture of the two. Suitability, risk, income, control, and timing all play a role in determining the debt-equity mix. The weights attributed to these elements will differ from firm to firm based on the industry and the firm's current status. Perhaps there will never be an accurate mathematical solution to the decision on capital structure design. Human judgment is crucial in analyzing conflicting factors before deciding on an acceptable capital structure. You were listening to the audiobook by the School of Management Studies IGNOU for MBA program. Course code Mmpc 014 Financial Management. Course coordinators Professor K. Ravi Shankar and Professor Kamal Wagricha. Voiceover by Harpreet Kaur. Edited by Savita. Program assisted by Tarannum Jahan and Jagbandhu Jana. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.